This is Ask Todd on the Financial Exchange Radio Network. If you have an existing estate plan or are in the market for one, Todd Lutsky is here to answer your questions and help you plan for later life. Ask Todd is presented by Cushing Dolan, serving Massachusetts and New England for more than 35 years, helping families with estate and tax planning, Medicaid planning, and probate law. Visit CushingDolan.com. Now, here's Todd Lutsky.
We are now joined by Todd Lutsky from Cushing Dolan. The segment is called Ask Todd because you get to ask Todd your questions about your estate plan. How great is that? The studio line here is 888-205-2263, so that's the number to call right now in order to be able to get in line and ask Todd Lutsky your questions about your estate plan. We've opened up the phone lines. That number again is 888-205-2263. So get calling and we'll get to your questions as they come in. My question comes first, though. Mr. Lutsky, how are you?
I am never better. You?
Not great.
Uh-oh.
Someone broke into my garage last night.
Yeah?
Stole my limbo stick.
Limbo stick.
How low can you go?
That's true. Yeah. That is just very bad.
You know, it's unbelievable these days. Let's talk a little bit about revocable and irrevocable trusts.
I'm ready.
Let's say that someone goes and sets up either one of these types of trusts that you frequently talk about.
Yes.
How do both of them impact that individual from an income tax standpoint?
Yeah, that's probably the best way to describe the differences and the similarities between these two trusts. So, one, when you have a revocable trust and you put your assets in, you put your investment portfolio in, your house, your rental property in, it's generating income.
Yeah.
Well, you got to pay taxes on that income every year, and because it's a revocable trust, everything that you have in the trust, like your investment portfolio, is titled in the name of the trust, but under your Social Security number. So if it's under your Social Security number, then you do not have to file a separate income tax return for the revocable trust because you're simply just going to put it on your 1040. Married or single, joint 1040 if you're married. No problem.
Sure.
Seems good. Well, it's the irrevocable trust that people worry about because you've heard, and probably Chuck, you've heard, that irrevocable trusts that could have that same rental property, that same investment portfolio in it, is generating income. Has to pay tax. And we've heard that trusts pay tax at higher rates than people, much higher rates than people. In fact, irrevocable trusts can pay taxes on income over around $14,000. You are now in the tip-top bracket.
Just at $14,000 of income.
Right. For humans, you got to be in the hundreds of thousands of dollars.
Sure.
Before you are at the tip-top rate for taxes. So seemingly, irrevocable trusts could pay taxes at a much higher rate, and that is true sometimes. Not this time. These trusts that we're doing while you're living, that's what we're talking about, while you're living, is a grantor trust, which means even though it's irrevocable, all that income that's generated, whether you actually distribute that income out or not, is going to be picked up on your individual income tax return because you're treated in a grantor trust as if you are the owner for income tax purposes, even though you don't get it. And therefore, they are income tax neutral, so you're paying the same tax you would pay if you had a revocable trust. The only difference, a slight difference, you need to file a 1041 income tax return for the trust, even though it pays zero income tax.
Talking with Todd Lutsky from the law firm of Cushing & Dolan. If you have a question for Todd about your estate plan, the floor is yours. The studio line here is 888-205-2263. That's the number to call in order to speak with Todd Lutsky right now about your estate plan. Live on the radio. Again, 888-205-2263 is our number here. We're going to take a quick break, but when we return, it's right to your questions. Again, it's 888-205-2263.
Ask Todd with Todd Lutsky every Wednesday at 10:30, only here on the Financial Exchange Radio Network. Todd Lutsky answers your questions about estate and elder life planning every Wednesday at 10:30, right here on the Financial Exchange Radio Network.
We're going to go right to your calls with Todd Lutsky now. First up, we've got Paul in Boston. Paul, you are on with Mr. Lutsky.
Good morning. Question. In Massachusetts, can a beneficiary be added to a will without using an attorney? The attorney who drew up the will is not available. So can this be done? And if so, is a witness needed? And could a husband be a witness for a wife and vice versa?
Yeah, probably. I would say you probably don't want to, I guess what you're asking is, can you draft a will? Forget adding somebody to a will. You're basically, the same question is, would you ever draft a will all by yourself, or would you go to a lawyer to have it done? Whether it's a brand new will or whether you're doing what you want to do, which is called a codicil to a will, or changing the will, if you will. There you go. But no, you're going to need two witnesses. It needs to be testamentary. You're going to need a notary. If you don't have the basic requirements for the will, adding the beneficiary will be unsuccessful. So I wouldn't try it on your own. It doesn't have to be, for just a simple will, you probably could go to almost any attorney if that's all you're doing, and they should be able to do a simple will. So even though the attorney you have isn't around or able to do it anymore, I wouldn't try it on my own. That'd probably be my advice. So hope that helps a little. And again, I think it's important to know, because he's doing a will and we're talking about differences from revocable trust to irrevocable trusts. Well, I can also tell you my general experience would be that a will is a won't, and it won't do most of the things that you want it to do, which is why we are talking about revocable and irrevocable trusts in our guide for this month. We are coming up to the end of the month soon, so please, if you'd like to learn the differences between a revocable and an irrevocable trust. And folks, for a lot of you, you might have done your planning and now you're older and maybe you want to switch, or you haven't done your planning and you're saying, which way should I go, revocable or irrevocable? You can learn the differences, and what I think you're going to find is more the similarities between these two trusts, not only from a funding standpoint and operational standpoint, but a tax standpoint. You're going to see that, and a protection standpoint from a nursing home, that there probably are more similarities than differences. Call and get the guide, 866-848-5699, or go to my website, legalexchangeshow.com. Download it there. Again, 866-848-5699 or legalexchangeshow.com.
Todd, I've got another one for you. We've got Michael in Boston on the line here. Michael, what's your question for Todd Lutsky?
Good morning. Thank you. Going back to taxes on an irrevocable trust, I'm the grantor of an irrevocable trust, and when I do my taxes, that trust income, as you've already indicated, is on my own 1040.
Good.
And Form 1 for the state. But I also do a 1041 and a 2G for the state.
Correct.
But I'm getting differences of opinion. Some say it's okay. Some say, no, you should fill out the whole thing. But I thought you have said in the past, you only have to fill out the top of the 1041 and write a letter attached to it that indicates that all of the income from the trust is on my 1040, and you delineate what that income is. Is that satisfactory, or do you have to fill out the whole 1040?
So you mean the 1041? You mean
1041,
1041.
Yes. And the 2G.
So when you say fill out the whole 1041, I can't understand why there would be a difference of an opinion here. When you fill out a 1041, which I'm suggesting that you need to do when you have a grantor irrevocable trust in which the donor and the trustee are not the same person, you need to fill out a 1041. When you fill out a 1041, you need to put all the required numbers on it. So like in Schedule B, you'll put your interest, you'll put your dividends. Schedule D will get the capital gains that you have for the year. You have to put that on there. So there's no option as to whether you're going to put that on there. What you're asking me is saying, oh, well, don't I have to put numbers on page 1 of the return. Instead, can't I just write that little blurb that you'll see on the front of page 1 that says, this is a grantor trust for income tax purposes and all the money is being picked up on the individual's personal return. That's going to print out on page 1 of the 1041, and no numbers will be on the 1041. You don't have an option on page 1 to be putting numbers on a 1041 if in the upper left-hand corner of the 1041 you've checked the box grantor trust. If you have, even if you're doing it on a computer, that page 1 will have no numbers on it. So I don't see the option. You got to put all that information in, and you got to file the return. So I hope that helps. The only thing I've heard some people say is maybe you don't need to file a 1041 at all, but I don't do that. When you have a grantor trust and the donor and the trustee are different people, even though it's a grantor trust, get the ID number and file the 1041. Hope that clears it up.
We've got one more for you, Todd. We've got Bill in Franklin on the line here. Bill, you are on with Todd Lutsky.
Good morning, everyone. Hi, my question is more probably subjective. I'd like to understand what are the criteria that we should follow as people without trust to enter into a trust. Like, for example, I'm in my middle 50s now, and my wife and I are considering going forward and making estate planning. However, we want to understand, are we too early, too late? I know it's not an age factor, but what's the criteria you recommend that we start engaging? Is it my asset count or what?
So here's a couple of questions that you can sort of run through. One, you said you're in your late 50s, perfect age. Do you have children?
Well, we're middle 50s. We have 5 adult children, 1 grandchild.
Excellent. And you have assets, I assume. So if you have assets and you have children, the answer is you're probably already ready to do estate planning, right? No matter what. Why? I want to avoid probate. If you want to avoid probate, that would be a reason. If your assets are over $1 million here in Massachusetts and you want to reduce estate taxes, that would be a good reason to do it so that I can reduce or eliminate my estate taxes. Do I want to make sure my children get assets in a certain way? Do I want to protect it from future divorces of the children? Do I want to, provide for them for their whole life and maybe avoid taxation in their estate when they die? That's a great reason to do estate planning. Again, if your assets are not overly large, maybe under $3 million, and you're saying, I'm approaching, in mid-50s, I get it, age might be a little bit of a problem, but, as I approach 60, 62, 63, I might be thinking about an irrevocable trust because I want to protect assets from the nursing home. So you need to ask yourself those questions, and if those things are important to you, you're ready to do an estate plan right now. And if it's not nursing home planning, then go with the revocable trust and at least avoid probate, provide for your children, eliminate estate taxes, protect kids from future divorces, make it easy for them. I think there's plenty of reasons to do it. Those are the kinds of criteria that I think about. So age does come into it. Size of the estate comes into it. Family dynamics come into it. Desire to protect assets from a nursing home or not come into it. Ask yourself these questions, folks, all of you, whether you want to do estate planning or not. And in that regard, this guide is actually right on money for you, Bill, and for everyone else. Hey, if you're just getting started, how do you know whether you want the revocable or the irrevocable? How do you know whether you want to trust at all? This guide will help you understand that, folks. Call and get it, 866-848-5699, or go to my website, legalexchangeshow.com, and you can download it right there.
Mr. Lutsky, thank you so much for joining us today.
Always a pleasure.
The views expressed in this segment are solely those of Cushing & Dolan. Armstrong Advisory does not provide any legal or tax advice. Please consult with your legal or tax advisor on such matters. Cushing & Armstrong do not endorse each other and are not affiliated. This has been Ask Todd on the Financial Exchange Radio Network. Ask Todd with Todd Lutsky has been presented by Cushing & Dolan, serving Massachusetts and New England for more than 30 years, helping families with estate and tax planning, Medicaid planning, and probate law. Call 800-393-4001 or visit CushingDolan.com.